Good afternoon and good morning, depending upon where you are. My name is Ira Goldstein, and I'm here with my colleague Maggie McCullough. We are both with an organization in Philadelphia known as the Reinvestment Fund. Today what we're going to speak to you about is some work that we've been doing for HUD, looking at a fairly specific set of questions related to the Neighborhood Stabilization Program. Before I get started, though, I wanted to recognize our colleagues at HUD, David Noguera, John Laswick, Hunter Kurtz, Sarah Stewart, and Ryan Flannery. And they are the people who've been sort of helping us create something that is hopefully most useful to HUD and to the grantees. And if there are questions that come up as we go through this presentation that are specific to HUD, one of those people will be glad to answer that. So with that, we will get started. I would say if you do want to ask a live question, that you will need to have a telephone next to your name in the participant box to the right of your screen, or most likely to the right of your screen. And if you don't have a phone icon, you can let the gentleman who's running the webinar know, and he will make sure that you have that available to you.
And this is Maggie McCullough. Twice during the presentation, because we know everyone is on mute, we will take a look at all the questions that have come in and respond to questions during those times.
So with that, the purpose of the analysis is to do a few things. Firstly is to see whether or not, or the extent to which areas in which there were concentrations of NSP investments, whether or not those areas changed over time in a way which was comparable, better than, or worse than areas just like them, or as close to like them as possible. The second purpose was to create a system to evaluate those markets against their comparable markets, and to do it in a way that is most easily understandable, and we'll describe how we did that. We were to create a series of maps and reports that will help grantees and HUD understand both where the investments were made, the kinds of markets they were in, and the kinds of change that was observed in those markets. And then to develop a routine process so that over the course of time, in fact on a quarterly basis, all of that information would be updated in a way that you as the grantees and HUD as the funder could understand the way in which those markets were performing. I'd like to say that, what we've done is to create something that hopefully will be useful to you. It is not the definitive word on the cause and effect relationship between these investments. We know that there are both strengths and limitations to the work that we've done here. But our notion was to try and get something out that would be useful and hopefully help you guide the way you administer your programs, with the notion that someday down the road, the more definitive study will be done. But for now, at least in sort of the R&D way that you're going to approach the way you execute your programs, having this information we thought would be useful. So the first step was to receive a database of approximately 50,000 investments from HUD. Those investments were put into the HUD data system by the grantees. We did some elimination of what looked like duplicates into the database that took us down to about 34,000 unique properties that were, we used the term treated by NSP, and that term treated is used to reflect the variety of different things that NSP could be used for, from demolition to rehabilitation to land banking, et cetera.
And some of those duplicates were not duplicate entries, but they could also have been a property that was treated 2 or 3 times under the NSP program under 2 or 3 activities. And what we wanted to do with this analysis was capture the properties themselves, unique properties that had been treated through the program.
And all that information across the country was taken and put through a process known as geocoding, which is, to essentially take the address and find its precise location in space, put it down on a map, and then be able to observe both it and everything else around it. The second step was to identify clusters. And really, for purposes of this exercise, we first had to define it. HUD had this notion of saying, in a way consistent with the law as Congress wrote it and the regulations as HUD wrote them, to find areas of great needs, but also to understand that these things would most likely be influential in a place where they could be of sufficient magnitude to stabilize a neighborhood. So what we did was we identified clusters as those places where there were at least 2 NSP properties treated within a quarter mile of each other. And this was a way of essentially trying to distinguish that clustered form of treatment from one where, every 6 or 8 or 10 blocks across a city you might find one or another property treated. It's a reasonably low threshold, but as you see, when you see the properties on a map, you'll see that it actually does make a reasonable amount of sense. We took all of the block groups that had this level of density in them, and we put them together into what we call NICs, or neighborhood investment clusters. And we'll use that term throughout, NIC or NICS, neighborhood investment clusters. There were some places where, as you started to combine these block groups into clusters, that the clusters got overwhelmingly large. And so there were places, for example, like the city of Detroit or the city of Cleveland, where there was so much problem to be treated and so many treatments made that it really would essentially have taken the vast majority of those cities and then turn them into essentially one cluster. And for purposes of being able to find comparable markets for this analysis, what we ended up doing was putting those clusters through technically a cluster busting process, so that essentially we created these neighborhood investment clusters with the rule that they could not exceed 4 block groups. The cluster busting, if anybody has questions about it, we can talk about that on or offline so that you understand how we did that. And again, once all this was done, each cluster got a name and a number so that their information could be tracked by you, by HUD, and then visibly seen on the map. The third step was to try and find areas that were essentially similar to the areas that had the cluster of investments. And I think for this, what you need to conjure up in your imagination is something of a real estate appraisal. And if you think about that, when you look at the appraisal of a single property, typically there will be information about that property and then 3 properties that are considered to be comparable. They'll be similar size, they'll be in the same geographic market, they'll have the same or similar constellation of bedrooms and bathrooms, etc. Here the analogy was we're not dealing with a single property, but we're dealing with areas. And so what we wanted to do was be able to find areas that looked as much like the NIC area, or the neighborhood investment cluster, as possible. At the same time, we not only wanted them to look as close as possible, but we wanted them to be not so close to the neighborhood investment cluster that it might have also been influenced by the NSP investments, but not so far away as to be non-comparable. And so what we did was we found block groups that were essentially at least 1/8 of a mile away. And then we allowed them to be farther, but the farther they got away from that investment cluster, they got essentially a small penalty in their comparability score for that distance. We went and found places that had median sale prices in 2008 that were as close as possible to the neighborhood investment clusters. And therein we were using data from it's essentially First American Real Estate, which is sort of processed and resold by Boxwood Means, and we have access to that data through the policy map vehicle that we have here at the Reinvestment Fund. And so we took the median home sale prices in 2008 and tried to find matches. We were interested in finding markets that were on the same trajectory of change, price change, over the last couple of years leading up to the recession that the Neighborhood Stabilization Program was a response to. And so we tried to match places in terms of the trajectory of price change. We also wanted to find places that had similar homeownership rates. And quite importantly was the NSP scores. As you all know, you were to a degree limited in the places that you could invest based on those NSP scores. And our thought was you couldn't compare a place that had an NSP score of a 10 in round one, for example, with one that had a 2 in round one, because that 10 was indicative of the fact that with all the data that was available at the time and everybody's best judgment, that area was at much greater risk than the 2. And so you would want to find places that were subject to similar amounts of risk. And then we also did some standardization for the number of housing units in the block group. As I mentioned before, areas were penalized if they got too far away from the NIC. And in addition, we did allow there to be, at our first pass-through, we excluded areas from consideration as comparable areas if they had any investment in all of them. As we refined the analysis, we did allow areas that had a minuscule amount of NSP activity and penalized if there was too much, to the point where at some level that NSP activity would exclude the area as a comparable area. And I would say also that we were trying to be as careful as we could about creating comparable areas that were within the same geographic market. However, in some instances, it became so limited that we needed to allow comparable areas to be found in geographies outside the county of the NIC. In that instance, though, the comparable areas had to at least touch the county boundary. And so, if you think about Washington, D.C., and, there are counties in both Maryland and Virginia outside, you could use a comparable area in Prince George's County if the block group at Prince George's County was adjacent to and touching the boundary of the District of Columbia. So that was the one caveat to being in the same market. Next, what we did was to take the two pieces of information that HUD expressed the greatest interest in tracking, based on, really, I would say, the intentions of the program as Congress created the program and HUD wrote the regulations for it, which was to stabilize those neighborhoods as evidenced by stabilizing home sale prices and stabilizing or reducing vacancy levels. Those also happen to be data elements that in many places across the country, if not most, where there's NSP activity, we'll be able to track those data on a quarterly basis. And so you'll be able to see over the course of time how well those NIC areas are performing vis-a-vis their comparable areas. And so what we would do is to essentially create two grades for each neighborhood investment cluster based on the extent to which it outperformed its comparable areas or any number of its comparable areas in sale prices and in vacancy levels. And we assigned grades to those comparables. We used A, B, C, and D. I'm dating myself by using E's. I'm told they don't use them anymore. Based on the degree to which those NIC areas outperformed the comparable areas.
And the lettering system, the A through D, was really, it's just an attempt to try and simplify for anyone that's looking at one of these reports to get a quick and dirty understanding of how that area of clustered investment performed against its comparable markets on either home sale or vacancy. It wasn't meant for any other reason than that.
And so this page of the presentation shows you how NICs got their grades. A NIC received an A on vacancy or sale price if it beat all of its comparable markets. Now, I just want to say that not every NIC had 3 comparable markets. There were instances where, for one or another reason, we could only find 1 or 2 comparables. But certainly 2 comparables.
Every NIC always had 3 comparables. We always found 3 comparable markets, but there wasn't always current home sale data to be able to compare how a NIC performed against each of the three comparables. So sometimes there might just be home sale data for purposes of comparison for two comparables against the NIC. So the A says how many ever we were able to compare a NIC against, it beat all of them.
And then if it had a B, it beat at least some of its comparable markets.
Right.
If it beat just one of its comparable markets, it received a C. If it did not beat any of its comparable markets, it received a D. And then if there was an insufficiency of information in order to calculate that score, then it received an NA. And later on in the presentation, you'll see some samples of the way those scores are reflected, both in reports and on the map. And at this point, what I'd like to do is pause for a moment and give people an opportunity to ask questions if they have any questions about the data or the strategy or anything that we've covered so far.
You can either ask a question by raising your hand or entering a question in the Q&A section below. One of the questions that we've heard from HUD as we went through this process and figuring out a methodology that made sense was why we capped the number of block groups in the cluster to 4. And as Ira commented earlier, part of it was because there are places, particular cities like Cleveland and Detroit, where there's been significant NSP investment, where when you clustered the investments, you ended up with large portions of the city essentially acting as a cluster. And you can't find comparable markets. So we had to break them up to allow for these smaller clusters and that we would be able to find comparables that we hoped made sense. Okay, the next one.
Okay, in terms of the summary of the results, what have we learned so far? As we covered earlier, there were, in fact, these 34,221 unique properties that had been treated by NSP across the United States. And we found that 15,000 or 45% of those properties do fit within our definition of a cluster. And that means the remaining 55% of the NSP investments would have been more sort of salt and peppered across the urban landscape or the suburban or the rural landscape. But in any event, they were not in sufficiently close proximity to be able to consider part of a clustering of activities. There were, in fact, 1,217 clusters across the United States, or neighborhood investment clusters, NICs. And NICs tended to be characterized by the following activities. Predominantly the clearance of the properties, about 58% of the NICs. The rehabilitation, about 14%. Land banking, about 7%. And acquisition, about 6%. There were a variety of other things that were associated with the NSP properties, but those are, in fact, the majority of where the clusterings are taking place. And it's worthy of note, I would say, that if you think about demolition, for example, or clearance is the way we've described it here. Oftentimes, that is, as we see, the kind of thing that's more likely to cluster than the occasional, for example, rehab of a property that was the broken window syndrome property on the block. And so the demolitions, for a variety of reasons, really do end up being clustered a little more, and I think that that's part of the reason that you see this predominance of clearance in the investment clusters. In terms of the performance, what we've observed is that with respect to home sales, about 72.5% of the NICs did better than at least one of their comparable markets between 2008 and 2010. About just under 20% got A's, and which means that they beat every one of the comparables against which they were studied. You'll notice as we go in further that for a variety of, and hopefully these are useful reasons for you, not only will you see scores that take you from 2008 to 2010, but also the annual changes. And that we think will be useful to you in terms of understanding a little bit about or putting the grade around the context of the investment. So, for example, if you look at the 2-year change, 2008 to 2010, that may look a particular way, but you may know, for example, that all of your investment activity took place late in 2009, and so it wasn't likely yet to have an impact on the data as we've reflected it. So that's the performance that you see with respect to home sales. With respect to vacancy, the performance is just a smidge better, so that you're seeing that about just under 3/4 of NICs did better than at least one of their comparable markets when it came to the vacancy rate between 2008 and 2010, and that just a little bit over 1/4 of the NICs beat every comparable that was available to them. And that would be, in terms of vacancy data, virtually everything had 3 comparables because the information was just a little bit more universally available to us. And so with that, I would like to pause again and ask if anybody has any questions about the scoring.
And it looks like there are a couple people that have question marks next to their names. I don't see hands, but I'm wondering if those question marks mean that the folks have questions. Chris Walker from LISC.
You'll see down the Q&A panel down at the bottom right, the questions in the queue.
Is there a call-in number?
We're working this out. Give us one moment, please.
The questions we're seeing right now have to do with joining the teleconference.
Keep scrolling down.
Here we go. Okay, so Chris has asked...
Hold on. Sorry. The question says, as Ira said, the 2 properties within a 1/4 mile criterion is indeed a very low threshold, hence the 45% figure.
And the question then is, did we experiment with other constellations of that definition, like 3? And the answer to that is yes. This number of the threshold that we used, which is 2 within a 1/4 mile of each other, that really associated with a pretty natural and observable break in the distribution of the density of the investments. The nature of that is essentially looking at geographies, starting with block groups, and looking at essentially how dense those investments were. And as I said, it's almost like there was an inflection point in the information at that 2 per 1/4 mile. After that, it really dropped off pretty significantly. And again, when you get the opportunity to look at the map of where all the investments are, and you will have that opportunity at some point in the not-too-distant future, you'll see that there really are a couple different kinds of places across the country, and this threshold tended to reflect that. But the answer to your question, Chris, is yes, we did try a few, and this one seemed to be empirically the most natural break for that density.
And then there was another question from Chris Walker. I realize that this is not your purpose, but is there any reason to believe that these results represent a departure from randomness?
Another good question, Chris. And that is something I think that we're going to figure out as we get more data in. It may well not reflect departure from randomness, but we don't know the answer to that yet. Moreover, I think that there will be a whole next layer of questions that attach to the nature of the activity that goes on in the place. So, for example, if it's a NIC that is characterized predominantly by demolition, does that act differently than, for example, a NIC that is characterized by rehabilitation or land banking or any of the other particular purposes to which NSP funds could be placed? And so I think the question is a good one. This one, at this point, really is just an opportunity to get a sense in general whether or not these clustered markets were acting in a way that looked different than their comparables. And to the randomness question, again, I think that you try and control for that as best as you can by having reasonably decent comparable markets. And as we dig into the reports and the like, you'll see that in some instances we were able to get terrific comparable markets. And in other instances, they were less good. And that's where you need, although we took every effort to find good ones, including sending out subsets of these things to local subject matter experts in the HUD offices and the like, to determine whether or not our strategy was producing good comparable markets. We know some were better than others. And I think that, as you, as a grantee, will look at your results, you'll have an opportunity to say, like, I know that scores well as a comparable market, but for all these different reasons it isn't. And if I consider this to be my comparable, then I can have more faith in one of the two grades, et cetera. So, it's a terrific question, and I think it's sort of the next step in the research to figure out whether or not and the extent to which these are really remarkably different than random.
We had another question from Neil Mayer, which is very similar. How do the summary performance results compare with what you might get from rolling dice among NICs and comparables?
Yeah, and that I would answer that the same way. Again, it's to a degree, you try and control the analysis to the extent that you can by finding good comparable markets. As I said, we know that some are better than others. And so I think that's one where with the local expertise, you'll be able to know whether or not the comparable is the right one. At the same time, I think that, as this is a first pass, eventually what we're going to likely find is that these NICs perform differently depending upon the constellation of what occurred in those places and the markets within which they occur. And that is, definitely sort of the next level of questions that will have to be addressed by us or some other set of folks who will take this data and dig, deeper into it.
We have another question from Cher Polenius. The question was, with clearance, did the data look at the initial year built and were more of these built in 1930 versus 1950s? Or was this not a part of the information collected? And the answer there is that we did not have any information about the structure itself.
Right. The only information we had available to us really was the fact that a demolition took place. There wasn't even information about the extensiveness of the investment. Was it a demolition which was very costly versus a quick knockdown? None of that other information. It was just the fact of what took place at the address.
A question from Paul Dennison. In describing clearance, did you differentiate between demolition combined with construction activity versus demolition only? And what we did was, with the help of HUD, we assigned the type of activity to the property they gave it a primacy code, so what they considered to be the primary activity on a property. So we could take a look at things that were just demolition versus things that were construction in combination. Another question from Kate Creeder. How do you evaluate areas with more than one grantee? So there are a number of clusters where there's more than one grantee involved. And on the maps, if you click, we'll show you, if you click on a property, you can see which grantee treated that property. And in the reports that we've created for each of these clusters, it tells you which grantees were involved in that cluster. And then you'll see that we also have reports for each grantee which talk about the clusters that they were involved in and makes note of where other grantees participated with them. So yes, we have that information. One last question from Honora Sixtina. Do these results represent the money spent under NSP2? If so, how much? So the data that we received did not have dollars attached to it, so we don't know how much money the properties treated represent at this time. That would be a question for another analysis, I think. Okay. So I think we will go on to the next piece of this conversation. So as part of our work, there are 3 deliverables that we are delivering to HUD, using the word twice. The first is a series of interactive maps where we have made available both the geocoded location of each property that's been treated with NSP, as well as drawn polygons of where these clusters are around the country. And these maps will be made available on the NSP website for anyone who goes into the NSP website to go to their city of interest, click around, look at the areas that were identified as NICs, as well as see where all the properties are located. And we're going to show you a couple of those maps in a minute. The second deliverable was what we called NIC reports. So these are these neighborhood investment cluster reports. And Ira talked about real estate appraisals when he was discussing our thought process in building these. And that's kind of what they look like. And we're going to walk you through a couple of them live as well. But in these reports, we've drawn the area that we've identified as a cluster. And then in columns next to it, shows 3 areas that our data identified as comparable markets. And then a whole series of pieces of information about the NIC as well as its comparable markets in those reports. So we're going to walk you through a couple of these in just a minute. And then the third deliverable was, as I was mentioning earlier, was every grantee will have a report also available through the NSP website that will give them information about where they've made investments, what percentage of their investments were captured within a cluster or versus scattered, and how those clustered areas performed under this grading system of A through D. So now I am very smoothly going to share my desktop with everyone and take you to some of these interactive maps which I was just talking about. So this map I've zoomed to Broward County, Florida. If we zoom out, you can get a little more information, a little more perspective on where you are in Florida. All of the orange circles on the map represent a property that's been treated with NSP dollars, and these blue outlines are the areas that we identified as clusters. And when you click on one of these clusters, information comes up in this bubble about the cluster. This is a cluster where a total of 15 properties were treated. One of those properties was clearance and demolition, and 14 were rehabilitation. And this link allows us to go into a report that's generating, which gives us more detailed information both about the clustered area, which is this area on the left, and that in blue. And then the 3 areas in red are the areas that were found to be comparable markets. And the little table up top here gives us the grantee's name, the total number of properties treated again, and the types of treatments that were applied to those properties. And then on the right-hand side, what that cluster had as a home sale performance score and what that cluster had as a vacancy performance score. And then if we scroll down in this report, it gives us more information up front about this NIC and its comparable markets and how why these places came up as comparable markets. So the first piece of information here is it's the distance from the NIC. So this first comp is 2.89 miles away. The second comp is much further away at 6.3 miles, and the third one at 2.25 miles. The NSP1 score was 9 across the board, and then for the last comp it was a 10. The median home sale price in 2008 in this cluster was $138,633. And then the three comps, 119.9, 141, and 169.9. Home appreciation, both all the NIC and the three comps, were trending down between 2006 and 2008 in the 40% range. They all had owner occupancy rates, 75% in the cluster, 71%, 81%, 75%. So these are predominantly homeowner communities. And then this cluster had 15 NSP investments, and the three comparable markets here, they were untouched by NSP. So then the next set of tables tells us about the home sale price in 2008, 2009, 2010. Again, the first column is for the cluster, and then these other three columns are for the comparable markets. And then it looks at home sale appreciation between 2008 and 2009, 2009, 2010, 2008, and 2010. So this was the 2-year time period that we studied. We do not have year-end block group level home sale statistics for 2011 yet. Home sale data runs 6 months. There's a 6-month lag, so it will be a little bit before we can use 2011 data here. But it shows you that in the target area, in this cluster, home sale prices trended down across all time periods, as did the other comparable areas, but it did so less. It did not go down as much as the other places. And then similarly, we have tables for vacancy. So you can see what the vacancy rate was in the first half of 2008, the first half of 2009, the first half of 2010, and then how those places changed during 2008, 2009, 9, 10, and then over the 2-year time period. And then we also included in this report a series of tables giving you up-to-date demographic information about the cluster and its comparable markets. And then the last table is information about the FHA lending and REO activity. So loans, the values of mortgage, the average value of mortgage, number of first-time home buyers, etc. And then the last map shows you in one place, much like an appraisal would show you where the location of the house is compared to its comparable houses. Here you can see, here's where that clustered area is. Here are 2 of the comparables, and then here are 1. So the analysis, and I don't know if you want to speak to this more, Ira, we did look, it looked for properties that were as close to, looked for areas that were as close to the NIC as possible, and met the other conditions related to home sale prices needing to be in the same range, for the trajectory needing to be on the same path, etc. And there are many places where the comparable markets are much closer, say, than this one, which is 6 miles away. But you do have markets where finding the one that seems to look most similar was at a distance.
Right, that's right, Maggie. And as Maggie said, in most places, particularly in the more urbanized areas, we were much more readily able to find comparables that were within a very close distance and met all the other criteria. This is a little bit unusual because of the settlement patterns of that part of Florida, which at that point there, you're sort of below Fort Lauderdale in terms of the geography of the state. So, and you can tell by the grid on the map that it's not as heavily densely gridded or populated as other parts of the country. And so in this particular instance, yes, indeed, we did go farther away. And I think this is the kind of on-the-ground interpretive work that people will have to do as they figure about how instructive these reports are for themselves. Like maybe you look at that comparable that's 6 miles away and say, you know what, I know we beat it, but something that's a totally different place, and maybe we shouldn't be holding as much stock in that one. Maybe there's not as much to learn from that one as we learned from the others. But as Maggie said, the important thing was always to try and find these places so that they met the criteria of being close in sale price, close in trajectory of sale price, close in NSP score, close in owner occupancy, and reasonably similar density.
Going to the other side of the country, we've zoomed in here to Bakersfield, California, where you can see a lot of NSP investment has taken place, and we've identified these 3 clusters here where they met the clustering criteria. And in this particular one, there were 33 properties that were treated. 28 of those properties were tagged as acquisition, and 5 were homeownership assistance. And so again, if we run the report for this area, same layout. So this first chart tells us, again, the number of properties treated and what kind of treatment those properties received. Here you can see in this grantee row that there were 2 grantees that were involved in the treatment of properties in this cluster. There was Bakersfield, California, along with Kern County. And we give you the number that was done by each grantee. So in this case, pretty much half and half were done by each. And this place received a home sale performance score of an A as well as a vacancy performance score of an A, which means that it beat each of the comparables against which it was studied. So if we go down, here is the clustered area. The first comparable is 1.42 miles away. The second one is 2.18 miles away. And the third one is 0.38 of a mile away. They all had NSP scores of 9. The first one had an 8. Median home sale prices, very, very similar in 2008. $154,354 in the cluster, $162,700, $159,700, $155 in the 3 comps. Home appreciation between 2006 and 2008, a drop of a little over 40% in the cluster, very similar drops in the 3 comparable markets. Owner occupancy rates, 67.6% in the cluster, 71, 67, and 58. Also, one thing to note as you look at these reports for your areas is that the comparables are ordered. In this first one is the best comp that we found, or we think it's the best comp for the area. The second one is what we believe to be the second best comp, and the third one is what we believe to be the third best comp. And then in this case, this cluster had 33 investments, and its comparables were untouched by NSP. So again, it's sort of looking to see how did an area that had some clustered NSP activity fare compared to areas that were relatively untouched, and in many cases totally untouched by NSP, very similar markets from the start. In median home sale statistics, again, the 3 time periods, 2008, 2009, 2010, and then you can track on an annual basis, 2008 to 2009, the drop. But the drop was certainly, it dropped more than it did compared to its first comparable, but less so compared to its second and third comparables, which is why it received a B. 2009, 2010, home sale prices went up during that time period by 6.02%. First 2 comps dropped. Third comp actually improved nicely. And then when you look at 2008 to 2010, it beat all of its 3 comps. It did not drop as much as the rest did when you looked at the full 2-year time period.
And largely that drop, really, as you can tell from looking at the annual slices of that, is it's largely a drop that was, at least with respect to the neighborhood investment cluster, the NIC is one that was concentrated in a 2008-2009 time period.
There are also some reports where you will see NAs in median home sale price or home sale price appreciation, and that's because anytime a particular comparable had fewer than 5 home sales, we suppressed it. We did not calculate a median home sale price, and we did not calculate a change. So that's what the NAs represent when you look at these reports. And then just as the last one that we looked at, residential vacancy statistics, and then a series of tables about the demographics of the area, FHA lending and REO activity in the area, and then a map showing you the clusters and the comparable markets. And then for each of these, so these interactive maps and, as I said before, and access to these reports will be available on the NSP website. And then in addition to each of the NIC reports, we've created these grantee reports. So in this case, this is a grantee report for Tamarack, Florida. I don't know how. Tamarack. Sorry. And the first table gives you detailed information about how many properties were found to be in one or more clusters. So there were 21. How many properties were outside? So there were 36 that were scattered for a total of 57 properties, the bulk of which, the vast majority of which were residential rehab. A little chart that shows you by property, by treatment type, the percent that were clustered versus the percent that were scattered. And then for this particular grantee, this grantee was involved in two clustered investment areas, two NICs, both in Broward County. It gives you how that particular NIC did for vacancy and on home sales, and again, the number of properties that they treated. And then there's a series of endnotes that talk about how things were scored, how the clusters were defined, exactly what we've been talking about on the webinar today. So I'm going to try and go back to the, stop sharing the presentation to see if we have any questions here. Okay. I hope that the audio is back on for most of it. Is the audio on for all of that?
I can hear you fine, Maggie.
Okay. So we have a question from Anurag. Is this data downloadable? And I think it's a question for HUD because the data that we mapped is all data that we received from HUD through the database that grantees use to enter their property information. So that may be a question for HUD. We have another question. Maybe you've already covered it and I missed it. There are currently mixed comparable trends from the first half of 2008 to the first half of 2010. When do you plan on updating the information from the first half of 2008 to the first half of 2012? So there's two answers. So we're looking at tracking home sales and we're looking at tracking vacancy. So the home sale data, there's always a 6-month lag in the data that we get because First American actually collects the data from local county recorders' offices. There's a lag in when they get the data entered into their databases for when First American collects it. So there's always a 6-month lag. So the first update that you'll see is a comparison to the end of 2011. And then in terms of vacancy, that is data that is from the Postal Service that we were receiving through HUD. I think that it has been halted for the moment, but when that data resumes and we're able to start collecting it again, we'll have that updated as quickly as possible.
And Maggie, let me just jump in real quick. This is Ryan Flannery from HUD. Regarding the question about whether or not the data will be downloadable, these data go down to the address level, so we can't make them downloadable at this time because of the privacy concerns. So the answer is no. If there's a way to mask the data and disseminate it once we do that, then we will look into that.
Okay.
Thanks, Ryan. Mm-hmm. There was another question about whether or not the NSP purchases and sales were backed out of the sale rate comparison, and the answer to that question is no. We have absolutely no way of doing that. In the comparable areas, obviously the NSP will be really quite trivial in terms of the sales activity. As you can see, at least in the examples that we showed you today, the NSP properties either are non-existent or would not ever exceed more than 2 or 3 in an entire block group. So I don't feel that that's as much of a problem in the comparable areas. In the NIC areas, on the other hand, it is possible that the sales of those NIC properties, to the degree that they were sales as opposed to demolitions or something else, that could potentially be an issue, but there's absolutely no way with the data that we have available to back that information out.
We have a question from Michael Gardner. When will the PolicyMap website be available for NIC searches, reports, etc.? So we are going to make these the interactive maps and the reports that I just showed you available on the on HUD's NSP website. So we need to talk with Ryan about timing on that, and then as soon as they are available, you'll be able to go in, play with the interactive maps, and generate the same reports that I just showed you today on your own for your area or other areas around the country. And we have a note that someone's not getting audio.
Maggie, it's Ryan again. I've had audio the whole time, so.
Okay. I don't know what that is.
One of the things, although people haven't raised it yet, but one of the questions that that both occurred to us and others have raised throughout this process is what can you do with the information as a grantee? What would you do with it? And it seems to me how I would think about the data in a couple different ways. I would really start to think about this information in the vein of like R&D. So here it is that I've received some HUD funding to do a particular set of activities. And as difficult as it was to execute under the constraints of the programs and the like, and I know we've all had struggles with different pieces of this, we're able to actually get some demolitions completed or rehabilitations done, etc. And then what we have is an opportunity to see whether or not where we did that activity in some geographic clustered kind of way, were we able to accomplish anything in that place than we were able to, than we might have otherwise have expected. And so if this was me and I was getting one of these NIC scores, what I would be doing is trying to firstly verify whether or not the information is correct. We have the information largely built upon the data that the grantees are putting into the HUD grant system. And you'd want to ensure that that information is both correct and up to date. The second thing is I would probably dig around a little bit and try and understand whether or not the comps that we identified are really truly good on-the-ground comps. In the case of the one example that we showed you, a comp 6 miles away may not, in the overall scheme of things, be a terrific comp. And in terms of learning something from the deployment of those funds, maybe there's not as much to be learned from that A than there might be from a B in some other comp. And so really to spend some time not just focusing on the grade, which is sort of just a scale score, but focusing on what it represents and what it's based on. And then lastly, I think I would probably try and understand a little bit about what's happening in the markets. Assuming for the moment that the comps are good ones, I would probably want to pay attention to, what other things are going on in that place. Are these places that the local city has been doing something in? Is this a place where there was, the completion of, some huge public investment other than a housing investment? Are these places where there has been a wave of abusive lending practices? I would try and sort of dig in and really understand what's going on in these different places to understand best why the area where I've clustered my investments either did or did not outperform the others. And lastly, I think what I'd pay attention to is although we've identified these as clustered investments, it's very possible that notwithstanding the fact that the investments were clustered, they really were not nearly enough to move that market. So there could have been in that place 50 vacant and foreclosed properties, and NSP allowed you to touch 2 or 3. Well, that might have been sufficient to define it as a cluster, but in terms of moving that market, that anecdotal information that you'll know from understanding what's going on in that NIC or its comparables will help you understand why it is that the place performed either better or less well than you might have expected. And so I wouldn't just stop with these grades. These are just really just an easy shorthand to be able to understand the nature of the investment and the things that were concomitant with that investment. But I think the real learning will take place as you dig into those NICs and the clusters and the activity to understand what it was that you were trying to accomplish there and whether or not, given the circumstances, you were able to do that.
And I don't know if anyone has any more questions, but this was the end of what we had planned to walk everyone through today. As I said, all of this is going to be made available to you soon through the NSP website. And Ryan, I guess you'll send out a message when that's all up and ready for folks to go in and access themselves?
Yes. Sorry. Was that you, Hunter?
Yeah, I was just going to say the webinar transcript as well as the slides will be available in the next few days on the website.
And the announcement is when deliverables will be available, the mapping tool and the reports themselves will go out through the listserv as well.
Great.
All right. Any further questions? Any last-minute questions? Great, terrific. Well then, I think on behalf of Maggie and myself and on behalf of HUD, if I may, I'd like to thank you for participating in the webinar along with us. There's, I guess, through HUD, you'll have the ability to access the information, and if there are particular questions that HUD can't answer, I'm sure that we'll be able to do that for you. And again, I thank you, and we're love to get any feedback that you have as you start to dig through the information. And with that, I will pass it back to HUD.
Thank you all for coming, and we appreciate you participating in the webinar. Just point out that next week on February 28th, we'll have our next webinar on Tuesday, which will concern NSP 1, 2, and 3 slow spenders. Just an opportunity to hear strategies and advice about getting and meeting those deadlines that are coming up in February. Thank you all.